Hello and welcome to Sprott Radio. I'm your host, Ed Coyne, Senior Managing Partner at Sprott. I'm pleased today to welcome Steve Hanke, Professor of Applied Economics at Johns Hopkins University. Steve, thank you for joining Sprott Radio.
Great to be with you, Ed.
Well, Steve, as a new guest on Sprott Radio, I thought it'd be interesting to hear a bit about yourself personally and then your extensive background in economics.
I'll try to keep it simple because I've been around for a while, and I really have had kind of three simultaneous careers that all overlap each other. One is as an academic, I'm an economist. Actually, the first faculty position I had was at the Colorado School of Mines many moons ago, but I almost into my 57th year at Johns Hopkins University, which has been home for most of the time. One year I did take a little trip out to the University of California at Berkeley, and that didn't suit me, so I retreated to Johns Hopkins. So that's the academic side, doing what academics do, and that's kind of career one. Career two has been in business and trading, and in that realm, there are many highlights, but one that was big was in 1995. I was president of Toronto Trust Argentina in Buenos Aires, and it was the world's best performing emerging market mutual fund. So that was a big deal. But there were a number of big trades. In 1985, I called the collapse of OPEC, and it did collapse in 1986. And I had a little model, and I made a forecast that the crude would fall below $10 a barrel, and it actually did. And at that time, I was at Friedberg Mercantile Group in Toronto, where I'm chairman emeritus, and we had very big short positions on crude. It was a spectacular trade. So that's part of the business side of the thing. And the third leg would be as kind of a political economist advising politicians and governments. One recognizable thing, I served on President Reagan's Council of Economic Advisors in the United States, but I've also had positions in Argentina and Estonia, Lithuania, Bulgaria, Bosnia-Herzegovina, Montenegro, Yugoslavia, Indonesia, and so on and so forth. So there are three aspects, really: the purely academic, scholarly side, the business and trading side, and then the political economy side of advising governments. So that's the three-legged stool, Ed.
And that's a very quick summary, because when I was preparing for this, your background and bio was well north of a solid page of just your accolades and all the different things you've been involved with, which was incredibly impressive. And for our listeners out there, I think it's worth noting that you have been at Johns Hopkins for over 56 years, and so I got to believe you've seen a lot of changes in the way we view data. What the economy is doing, with quantitative easing and Operation Twist, that whole narrative. So I'd like to start with maybe talking about, over the last, 5 decades plus, what has surprised you and what has largely remained the same?
I think the biggest thing, and it wasn't exactly a surprise, but it is something I've observed, is that economists have wandered further and further away from the real world. So they spend their time piddling around with various kinds of theoretical models that have almost nothing to do with the real world whatsoever. For example, let's look at macroeconomics. Macroeconomics, the models that are used are what we refer to as broadly neo-Keynesian models. But these models of the macroeconomy don't even include an aggregate metric or measure for the money supply. For me, macroeconomics is monetary theory plus capital theory. And my most recent books are what? One I co-authored with the great polymath Leland Yeager. It's called Capital, Interest, and Weighting. Palgrave Macmillan put that out about a year ago. That's a book on capital theory. And the most recent one that was released by Wiley in May, I co-authored with Matt Sekurki. It's called Making Money Work. And that's about monetary theory. So you got those two books, and that is macroeconomics, but none of that is in the neo-Keynesian models that have been used really for the last 30 years. And if you look at the Federal Reserve, for example, Chairman Powell has said publicly that they don't pay any attention to the money supply. Now, he doesn't say that it's not included in the models that they use, but it's not. They pay attention to the interest rate, which is in the models, but the money supply is not. And my view is that monetary policy is not about interest rates, it's about changes in the money supply.
Why do you think they're getting that wrong? Because I don't disagree with that, obviously. I mean, I know if I have more personal money supply, my life's better, not worse. But I think it's the opposite with government. What's going on there? Why are they discounting that?
Well, it is these models. So you say, well, Hanke, you've been in trading and paying attention to the markets and that kind of thing, but you're also an academic. Well, the academic part, that's where the disease is coming from.
Hmm.
Because these models, traders don't design these models. This comes from the academy. And it is neo-Keynesian. By the way, unlike Keynes, because at least Keynes, before the general theory, if you look at that treatise, the 2-volume work that Keynes did before the general theory, that's basically about money and banking. So the thing is morphed. In a way, Keynes even morphed from himself when he wrote the general theory. But the Keynesians and neo-Keynesians now are way away from monetary theory and the quantity theory of money, anything like that. So that's the story. I mean, the models are not that way. If the models aren't that way, that's not the way the policymakers are getting their advice. They're getting them off these models that I think have very little connection to reality.
Is that where maybe we're starting to go astray here a little bit then, as the models have evolved and the politicians are making decisions off these current models? Is that maybe causing a bigger problem than maybe even they realize?
Oh, I think it is for sure. And it causes problems in the press because about 75% of all the research in money and banking is done either by the Fed in the United States or people who used to work at the Fed or people who've been in academia who've been financed by the Fed. So the gatekeepers, kind of, shall we say, are Fed economists one way or another. And the Fed economists are using these neo-Keynesian models and have embraced those. So what the press gets from whoever they're talking to, whether they're talking directly to someone at the Fed or an academic, or they're talking to somebody who's been around the Fed or financed by the Fed one way or another. So they're all feeding at the same trough, and you can't blame the journalist in a way, because if they go back to the primary data and the research and so forth, it's all based on certain kinds of models, and the journalists, they're not in the business of modeling. They're in the business of reporting what's supposedly going on. And so we get a steady stream. Not only we have the research based on one thing, but the press is dominated by it too. And of course, the press is dominated by whatever the press office is saying at the Fed. That's the main source of everything.
The topic you hear more and more is debt to GDP, or just debt. Can we service it? Does debt even matter? I mean, a few years ago, there was a whole theory that debt didn't really matter as long as you can service it. Is money supply at all factoring into that then? Are they rolling that all together as one term, or what's happening with that?
Well, it comes kind of indirectly in the following sense. If the government's running a big deficit, they can finance that deficit by selling treasury bonds and bills to the non-bank public. That's one way to finance it. The other way to finance it is to sell part of that to the non-bank public, but part of that debt to sell it to the Fed. And if that happens, it gets monetized, and the Fed creates credit. It creates money to buy the treasury bonds. And that's what happened in 2020 and 2021. We had a very sharp increase in the deficit in the United States. Remember, that was the pandemic hit in February of 2020, and the economy was shut down. And at the same time, the government spending kept going. The receipts weren't coming in. The deficit soared. And about 90%, a little over 90% of that deficit actually was financed by the Fed. And they just created money.
Mm-hmm.
And when that happened, what happened? The money supply skyrocketed. Actually, it went up at its highest rate of growth since the Fed was founded in 1913 was after the pandemic. And as night follows day, Ed, we had what? Inflation.
Mm-hmm.
And we also had a huge increase in asset prices. That happened before the inflation. Asset prices went up, land prices went up, housing prices went up, all kinds of physical assets went up, precious metals went up. That distorted the income distribution in the economy. The monetary policy not only was loose and inflationary, it was non-neutral. And Sakurki and I talk a lot about this neutrality thing in our book, Making Money Work. And the monetary policy should aim to be neutral. It shouldn't be biased towards favoring particular groups, sectors of the economy by income. Now, to give you an idea of what happened, in January of 2020, the billionaire's wealth as a percent of GDP was 14.1%. Today, it's 21.7% of GDP.
Wow.
The rich became very rich with this explosion in money. So who says the money supply doesn't matter? This is a joke. Any normal person knows very well that the money supply has a big influence on inflation, a big influence on the rate of growth in the economy, and a big influence on the distribution of income, because who benefited from the explosion in the money supply that caused an explosion in the asset prices? People who owned assets.
Mm-hmm.
Well, who owns assets? Well, rich people own assets. It's a pretty simple game. And this is what you don't find. You said, well, what's been the big change in economics? It's exactly this is the kind of thing we're talking about. Economists don't look at this stuff. They're fooling around with equations and models and so forth, and hardly ever looking at actual data in the real world and the causality and link between the biggest factor that causes changes in the economy, changes in the money supply. I've looked worldwide, and there's never been a significant inflation in the world. That's an inflation I define as 4% lasting for more than 2 years. That's a significant inflation. And there's never been a significant inflation unless it's been preceded by significant increases in the money supply.
But it sounds like to me, by not including money supply or not emphasizing that, I don't want to go as far as saying they're doing sort of a shell game with their data, but it does sort of feel that way. Talking about moving the goalpost on inflation, we had 2% as our target. And I said, well, maybe we're close enough. We're going to start lowering rates. I mean, I guess that's what I want to really get to is why is the Fed not holding pat? Do they need to lower rates? I mean, let's talk about the rates for a minute, because that seems to be getting all the headlines right now. Wall Street sort of prognosticating 2 more cuts. Like, what's your view on that? Are we too early, too late? What's your view on what the Fed's doing now?
The easiest way to find out where they're going, just go to the Chicago Mercantile Exchange. There's a Fed funds futures contract. See how it's trading. The Chicago Mercantile Exchange has worked out the probabilities derived from the market trading that indicate what's going to happen to the Fed funds rate. And we have a meeting coming up in the Federal Open Market Committee in October and one in December. And it looks like with a very high probability, around 75, 80%, that there'll be a 25 basis point cut in October and another 25 basis point cut in December. Those are objective data, by the way. They're market prices.
Being on the precious metal side and the critical material side of things, we constantly get asked about cryptocurrencies. So Before we go into gold, because I do want to hear your view on gold and if that's relevant in today's marketplace, do you think cryptos in general, or maybe just Bitcoin or something new that we don't even know about yet, do you think they deserve a seat at the table as it relates to the economy and talking about different levers we can pull? What's your view on that if you have one?
There are different kinds of cryptos.
Mm-hmm.
Bitcoin is one, and Bitcoin's just a speculative asset with no fundamental value whatsoever. So that's Bitcoin. Now, these stable coins are something else, because the stable coin is issued, but now with the new regulations put in place, theoretically, they're supposed to be backed by dollar denominated assets. So you can exchange the token for US dollars at a fixed rate. So trumpets is that, well, the stable coin legislation will require that the stable coins be backed by U.S. treasuries, and that'll increase the demand for U.S. treasuries, and that'll make it easier to finance the U.S. deficit. That's one argument.
Mm-hmm.
It does come into play in that sense. It doesn't really do anything to the economy in the sense, if anything, it slows it down, because these are speculative assets, and to buy them, you've actually got to use real money. These speculative assets, it's like buying, fine art or something like that. You buy a painting, and what's a painting do? Is the painting producing anything?
Mm-hmm.
You get a non-pecuniary benefit from the thing, assuming you have it at home and you're enjoying it. It's not like investing in a bankable project, a factory or something, or a store or something like that. So that's how it's kind of connected to the economy, and where it goes from here, who knows?
That will be interesting for sure, and I do think it's interesting you call it a speculative asset. I always sort of thought of Bitcoin, and I don't want to be a hater on Bitcoin because I do think they've opened up a really a nice conversation on why having assets out of traditional markets and so forth. But it feels a little bit like Netscape. Not to pick on Netscape, but there's it's a technology, and technology is constantly evolving. So it'll be interesting to see how this story ultimately evolves or ends over time. Speaking of painting, speaking about things that don't do anything, Warren Buffett loves to hate gold because of that. But I know you've talked about gold in the past and sort of its role in the economy. Is it still relevant? We've seen a tremendous move here recently and central banks are buying it, but I'd love to get your view on this because you've been at it for so long. What do you think of gold today? And I guess two parts. What do you think of it today? And are you surprised by this aggressive move we've seen in it from a price standpoint?
Okay, what I think about it today is that gold has always been a part of the international financial system, and I can't imagine a system without gold being part of it. It's been around for thousands of years, and it's not going to be displaced by cryptocurrencies or something like that.
Mm-hmm. Okay.
And that's the end of that story. Now, what about the market? Well, the market, it's interesting. People aren't talking about it very much. They talking on and on about Bitcoin and cryptos and things like that, but not about gold. But gold's up 45% this
Mm-hmm.
year. It's making new highs as we speak. On the 30th of September, it's making new highs almost every day.
And that gets me to the second part of that question. How is this environment different than, say, 2000 to 2011, the last time we saw gold really, generate interest and people allocate to, and then the miners exploded and all that? How is this run up or this environment different from what we saw over those 11 years?
The market is exactly what it was that last secular bull,
Mm-hmm.
as far as the market activity and things like that. But this time the narrative is a little bit different, with central banks buying big time, particularly Russia and China. Part of that story are sanctions, the financial sanctions the U.S. has put on, especially Russia, and threatening other countries with sanctions, either direct sanctions or secondary sanctions. So that weaponizes the dollar and spooks not only retail investors, but also obviously central banks. So the weaponization of the dollar is a big thing now. It's different. It creates a huge commotion, and people start thinking about, well, maybe it's a good idea to squirrel some liquidity's away in gold. Maybe gold's a safe place for it, and so far it's proven. The proof of the pudding is in the eating. The eating's pretty good. As I like to say, as a gold bull, buy gold, wear diamonds.
There does seem to be this verbiage out there right now that gold is overbought. And it does seem to be that way from a narrative standpoint. People are certainly talking about it, but it doesn't seem to be that way from a capital allocating standpoint. We don't see a lot of money, internally even flowing to the space yet. It still seems to be grossly underowned. So do you feel that investors, that purely from an investment standpoint, are missing this move or missing this party, or is it potentially just kind of warming up if you're calling for 6,000?
I think that they've missed a lot of it. There's still a lot left, a lot of juice in the lemon.
Mm-hmm.
The thing is, it depends on what country you're in. If you're in China, that's not the case, because the Chinese buy gold. The Indians buy gold. In Europe, to some extent, and the U.S. even more so, the retail investor has been underallocated for sure. But part of this narrative, you not only have Warren Buffett, who doesn't like it because it's not yielding an annual return, and in that sense, it is speculative. But the negative narrative that it's not going any place, it's something not worth having, and so forth and so on. A lot of that comes from the crypto crowd.
Right. Well, it's amazing to me when you look at the performance. For the last 2.5 decades, that rock that doesn't do anything has outperformed the S&P 500, which is loaded with intellectual capital and dividend-paying stocks and value creation and new products and ideas. Yet this rock continues to add value. So I don't know when the world sort of wakes up to that, if they ever do. But it's just been fascinating from an investment point of view to watch that happen. And hearing your economic point of view and your academic view on it as well is also equally fascinating. Well, Steve, thank you for sitting down. It's been really enlightening, and maybe more people will pay attention to the money supply, which to your point is an important one. So it's a treat to have guests like you on. So thanks again for taking the time to share your thoughts on Sprott Radio.
You're welcome, Ed. Thank you for inviting me.
Well, thank you, and once again, my name is Ed Coyne, and you're listening to Sprott Radio.
This podcast is provided for information purposes only from sources believed to be reliable. However, Sprott does not warrant its completeness or accuracy. Any opinions and estimates constitute our judgment as of the date of this material and are subject to change without notice. Past performance is not indicative of future results. This communication is not intended as an offer or solicitation for the purchase or sale of any financial instrument. Any opinions and recommendations herein do not take into account individual client circumstances, objectives, or needs, and are not intended as recommendations of particular securities, financial instruments, or strategies. You must make your own independent decisions regarding any securities, financial instruments, or strategies mentioned or related to the information herein. This communication may not be redistributed or retransmitted in whole or in part, or in any form or manner without the express written consent of Sprott. Any unauthorized use or disclosure is prohibited. Receipt and review of this information constitutes your agreement not to redistribute or retransmit the contents and information contained in this communication without first obtaining express permission from an authorized officer of Sprott.